There was a great question in the forums just the other day about how the global equity markets impact each other as well as impact the Forex. There is actually quite a bit of information to be gleaned out of the international equity markets and how they relate to each other as well as the Forex. And some of these are a much more stark contrast than others. Part of the issue, of course, that we're dealing with is that largely equity markets tend to follow each other. The exception to that rule is emerging market equity markets tend to they will oftentimes decouple from the bigger equity markets like the equity markets in the U.S. or in the eurozone. In fact, the chart that we're looking at right now, this is a index. This is a Select Spiders ETF. So this is something that you could pull up for yourself on any free charting application. So it's a good reference. It's a nice broad selection of stocks listed, public stocks listed in China. The symbol is GXC, as you can see it here, but you can pull it up on any charting application in that same way. It's an ETF, so you could even buy it as a stock if you wished. So this is a broad section of what's going on in China. It's interesting because it has decoupled a little bit here recently from a lot of the global equity markets, including the U.S. equity market. And it's been interesting. It's got a weird cause and effect here. As it's been declining, worries about escalating oil costs have been also declining as folks are looking at the equity index here in China as an indication that Chinese demand for oil may in fact be dropping. That in turn turns out to be really good for U.S. equities. So we see U.S. equities here recently diverging just over this most recent time period from what's been going on in China. Now, we're sitting on top of a fairly significant support level. If I just draw a line right across the bottom here and then back up a little bit, you can see something very interesting beginning to emerge. So this hyper growth that occurred last year, we had a little rally there the middle of last year, a big rally the end of last year, several price shocks in a row through the middle of this year, another rally. Now we're sitting right on top of that. Does this pattern look familiar or what? Of course, it's a head and shoulders pattern sitting on top of its neckline. So a decline here, a break of the neckline, we would expect a big, more additional decline. That could be good for oil prices, meaning to the downside. Which in turn could actually help escalate things in the U.S. So this is an interesting inflection point where they've broken each other's trend, but they are fairly correlated in other ways. So for example, you'll notice the price shocks that were occurring up here, very significant volatility occurring here beginning of November 2007, and we can go take a look at what was going on in the U.S. equity market at the same time. Of course, October, November, that was when we started to get some really big volatility to the downside, including that huge decline that we experienced in December and January. So we can see this correlation that exists, including the top early this year in May on the SPX, correlated with a top and a decline here in Chinese equities. But there are some places that we should be concerned about this. Chinese equities, like all equity markets, represent higher risk assets than, say, for example, government bonds or fixed income, things like this. So it's going to not only be correlated to other equity markets, of course, and the recent history being kind of an exception to that. So there is some independent movement here recently. But it also it has a significant role in what's going on in the Forex. So I mentioned that it's Chinese equities in particular are going to be representative of a very high risk asset. Well, you can see I just zoomed in here on a big hammer that occurred on 320. So March 20th, that's a very bullish candlestick pattern on Chinese equities occurring on 320. We can take that over to the Forex. 320 coincides with the start of this rally here that extended through March, June, May, April, etc. So and in fact it's only been recently that we've seen a real divergence as U.S. equities break away from Chinese equities to the upside and dragging or pulling the the Japanese yen along with it. So as traders see less risk in equities, including Chinese equities, they will have a tendency to move into higher risk assets across the board. That includes less pressure on yen shorts and more yen shorts being initiated. So a weaker yen, stronger equities equals a weaker yen, and it is one of those markets that we watch fairly closely for that type of behavior. Now, the Chinese equities, when we get they're particularly susceptible to price shocks to the downside because the market is so inflated. So if we do get big moves on the GXC, so this Chinese equities ETF, such as we did back in January, and then going back even further with big moves in October, November, etc., then we pay particular attention to what's going on the dollar yen. If we scoot back there for just a second, you can see that those big price shocks in January on the GXC, which were occurring about the 17th or so of January, and we get this real stunted rally on dollar yen, the dollar yen pair. In fact, even right now, we're still getting a little bit of a stunted reaction today with, despite the fact that U.S. equities are up, we don't have, the dollar yen was not up. So we're getting this little bit of pressure on the dollar yen because Chinese equities are down. So we're seeing this, there's some indecision in the investor sentiment marketplace where, sure, traders are looking at higher risk assets, things like U.S. equities, but they are still not liking Chinese equities. And so we're seeing a fairly flat day, a fairly flat close from Friday's close on the dollar yen. So this is one example of where once we get this disagreement, that can lead to that can kind of hold the dollar yen down. So it's one that we are going to be watching fairly closely, because in turn, if U.S. equities begin to follow Chinese equities in the correction that they've been in for the last few weeks, we could definitely see a correction here on the dollar yen as, again, representing a shift in risk or sentiment about risk as traders move out of equities. That's going to create a problem with a short squeeze on the yen that's going to drive the yen's value up, and we'll see the yen decline. So it's something that we look at from a macro perspective like that. On the shorter term, it's not as predictive. So oftentimes traders are looking for that relationship that's going to give them a heads up as to what's going on in the equity market the following day. Can they look at what happened in Euro equities or UK equities or even Chinese equities to give them a heads up as to what's going to happen that next day on US equities? But a lot of that inefficiency is really traded out of the market. So if you get a big up day in Europe or in China, and then U.S. equities, which just a lot of very positive equity bullishness out there, U.S. equities are going to gap up in that morning. So you're not going to really see a lot of that. It's very difficult to take advantage of that movement because you couldn't actually get into U.S. equities before the market open, and it's going to gap up and kind of accommodate that overnight bullishness that's going on. And the same thing is true with the Japanese yen, where it's going. You can see this happening today, where Chinese equities were being driven down overnight, and the dollar yen was in fact being driven down. Subsequently, once U.S. equities came out and started opening up and climbing, we see the dollar yen kind of catching up with this. So it's very continuous movement. It's difficult to say, well, in the short term, there's something here we can take advantage of. So what we really look for, bottom line, we look for big price shocks. If we see big price shocks in Chinese equities, then we look for, to the downside, then we look for a stronger yen. If we see Chinese equities appreciating in value, then we're going to be looking for the yen to depreciate in value, just following that risk cycle. What are traders in the mood for? What kind of yields are they looking for?